Hello, and welcome to the Latin America Virtual Forum, with content produced by BlackRock and support provided by the team here at Bloomberg Línea. My name is Nicholas O'Connor, and I will be guiding you over the course of the next 3 days. We'll be hearing from leaders from BlackRock, as well as a range of invited speakers. We'll be discussing technological disruptions and the transformation of the investment industry to a net zero economy, ensuring access to investments, and the role we all play in building a better future. Depending on where you're watching us, you can access the content in English, Spanish, or Portuguese. This stream is going out via Twitter, Facebook Live, YouTube Live, Twitch, and Instagram, and we'll have additional content going out on TikTok. Now, to get us started, I would like to hand you over to Dominic Rohe, Head of Latin America for BlackRock and the host of this event. Dominic, good morning.
Thank you, Nicholas. Welcome, everyone, to BlackRock's 10th Annual Latin American Investment Forum. We have an amazing 3 days of content set up for you with thought leaders across the firm. I also would like to thank our sponsors, MSCI and IHS Markets, now part of S&P Global. With that, let's transition to my conversation with Larry Fink on global markets and the world. Thank you very much for listening. All the best. Larry, thank you for making the time today to speak to us. Really wanted to start this by having a conversation around what's happening in the markets. You know, we have had a very turbulent start to the year. We have a war in Europe. You have been traveling quite a bit. You came back from the Middle East recently. I would love to hear your view on what you're hearing from world leaders, what you're hearing from corporates, what is surprising to you, and a little bit of an insights from your trips would be great. Thank you.
The global capital markets are the major engines for every country in the world today and for those countries that are trying to develop, having access to capital in the global markets is really critical. And as I wrote in my CEO letter earlier this year, access to the capital markets is not a right, it's a privilege. And now the actions of Russia.
Thank you, Nicholas. Welcome, everyone, to BlackRock's 10th Annual Latin American Investment Forum. We have an amazing 3 days of content set up for you with thought leaders across the firm. I also would like to thank our sponsors, MSCI and IHS Markets, now part of S&P Global. With that, let's transition to my conversation with Larry Fink on global markets and the world. Thank you very much for listening. All the best. Larry, thank you for making the time today to speak to us. Really wanted to start this by having a conversation around what's happening in the markets. You know, we have had a very turbulent start to the year. We have a war in Europe. You have been traveling quite a bit. You came back from the Middle East recently. I would love to hear your view on what you're hearing from world leaders, what you're hearing from corporates, what is surprising to you, and a little bit of an insights from your trips would be great. Thank you.
The global capital markets are the major engines for every country in the world today and for those countries that are trying to develop, having access to capital in the global markets is really critical. And as I wrote in my CEO letter earlier this year, access to the capital markets is not a right, it's a privilege. And now the actions of Russia and Ukraine and the quick and sudden response by government, but more importantly, by private companies in leaving Russia and just changing their whole circumstance. And companies around the world are reevaluating what should they be doing related to Russia. So all of this is really reshaping the world. In many ways, you could say maybe the world's going to be better off. I do believe Europe is going to be better off, Dom, because it's going to become less dependent on Russia. They are now going to take responsibility in building up their defense. They are going to take much greater responsibility related to their energy independence. And most importantly, they're going to rely on multiple sources for energy. And what I believe in my conversation with political leaders and CEOs around the world, I think we are all now reevaluating all our dependencies. Should we be dependent in one country and manufacturing 50 or 60 or 70% of our goods or assembling our goods? And I really believe this is going to reshape all the supply chains. Now, the supply chains were being threatened, as we all know, because of COVID. And we've seen huge shocks, whether it's semiconductors, and now we have shortages in so many things. And now with the shock of the war and the shock to the energy market, but also, as we know, the shock to food, to the basic foods of wheat and corn. And we're seeing the attendant rises of prices. Every company is now asking us, how do we now minimize any dependencies? Mm-hmm. And Dom, I think this is really important for LATAM. If the Brazils, the Mexicos, the Colombias, and on and on and on, focus on saying we're open for business, we're going to see more companies nearshoring or onshoring, closer to demand. And I truly believe Mexico, because its geographic proximity to the United States, is a huge beneficiary if they work toward that objective. So we're going to be seeing this whole revaluation. And I do believe, unfortunately, this revaluation is going to reshape how the world is. There are going to be big winners and big losers. But importantly, also, what I'm suggesting is inflationary too. Creating the most efficient supply chains that we've done now for 30 years, this post the breakup of the Soviet Union, we were able to create more of a deflationary world. We were able to create much more efficient worlds, higher productivity. And what I'm suggesting now, you're going to see more and more companies focusing on maybe redundancies in supply chains. So they're not one dependent. That's highly inflationary in the short run. Now, 5 years later, 6 years later, this could be deflationary as we build up more and more capacity. And let's be clear, $100 to $110 to $120 and beyond energy prices is going to accelerate decarbonization. As of today, natural gas in Germany is $35. It's still $5 in the United States, up from $2. But the pathway towards decarbonization at that price, not at the U.S. price, but the price that Germany paid, is very strong. And so you're going to see much faster movement towards hydrogen and green and blue hydrogen. And so all of this is positive. Let me just give you the other silver lining. As Europe tries to find its balance related to Russia, and they're building more supply chains and less dependencies, and they're building up their defense spending, as they're building more of their infrastructure spending. This is a silver lining that you're going to see more fiscal stimulus, which will then probably stabilize the world and probably provide a basis for a world that is not in a deep recession if it comes to that. So this is one of the reasons I'm not a big believer that if we have a recession in the world, or in Europe specifically, it won't be long. It'll be short-lived because of all this fiscal stimulus. So all of these are changing. And gosh, Dom, I don't think I would have been talking about any of this right now 4 months ago, 5 months ago. So here I am really talking about how this is all shifting and how should we think about it. And they're going to be big winners and losers. And so I'm spending a lot of time talking to our clients. I leave again tomorrow for Asia. And it's for me to learn what's going on and how they think.
Yeah, and that's, you've spoken now for the last 2 years about this transition and nearshoring, this idea of bringing more of the supply chain closer. We've talked about that when we traveled in LATAM as well. And I think this will just accelerate that process. And I think it's great for our Latin American countries in which we operate. Quince, I have a question regarding this transition finance. In your recent letter to CEOs, you talk about that we focus on sustainability not because we're environmentalists, but because we are capitalists and fiduciary to our clients. And I would love for you to speak a little bit about what that means, what this transition means from brown to green, because people sometimes think of, we flip a switch and we go from brown to green. And I would love for you to kind of speak about that and demystify that a bit.
Well, I think a lot of governments wanted to go from brown to green, and now we're sitting with this big problem. And every politician is backtracking. And think about what Europe did. Europe was probably the most advanced towards sustainability, but they didn't create a proper pathway. And because of rising energy prices, most governments in Europe now are putting caps on the cost of energy to their citizens. And it's just a part of the fiscal drain now. So they're subsidizing everybody in their country because they are not prepared. Look, I have always said, and I've said this for the last 3 years in my CEO letters, we're not going to brown to green. We're going to go from dark brown to medium brown, to light brown, to lighter brown, to lightest brown, to the very faintest brown green, and on and on and on. And we have always said it's not going to be a straight line pathway. It's going to be a very lumpy pathway. And that's what we're seeing. And the problem is politicians cannot think beyond what's happening today. And we're seeing policy shifts that are dramatic today versus policy shifts 6 months ago, 8 months ago. I was in the Middle East twice in the last 4 weeks. There is not as much excess supply in OPEC than I think the market's suggesting. And the reality is for the Saudis and the Emiratis to produce, let's say, 1 million more barrels, it's like a, $20 to $50 billion investment, and they have to analyze, when it takes, what is the break-even point for that further investment? And the bigger problem is we don't talk about, because of the pathways of so many countries, especially in Europe and the United States, they inhibited reinvestment. And you need to invest at least 7% every year to keep your supply flat. And what we've seen for the last 4 years is an underinvestment, and that's why we've had this reduction in supply. Demand for hydrocarbons will continue to grow as the world grows. At the same time, elevated prices like we're seeing now will accelerate new technologies, will accelerate substitution. And so the pathway for sustainability is real. BlackRock has always said we don't believe in divestiture, and I think we've been very firm on that. So we believe the transition is going to be long. I wish we had the technology that we could turn a switch on and become green. The most important thing, and this is so evident in LATAM and in every other place in the world, any transition to work has to be fair and just. Higher prices is not fair and just. It hurts the poor. It hurts the poor countries. And that's what we're witnessing now. We're witnessing the spike in food, the spike in energy, and it's really a major tax on when you think about the percentage of the average person, whether they're in the United States or Mexico or Brazil, I mean, there's differences, but the amount we need to spend for energy and food as a percent of our living and our wages has grown dramatically. And these are real structural issues. And so getting back to transition, and I'm a firm believer that this transition will happen. I'm a firm believer that we have to invest side by side with hydrocarbons and investing in more decarbonized technologies. And I do believe, we have to judge those pathways and manage those pathways successfully. This is a long-term complex process. And, as a result of these higher energy prices, I think the world is going to have more hydrocarbons in the air next year than ever, because we're utilizing more coal than ever before, because coal is still cheaper than some of the other hydrocarbons. But let's be clear. The prices that we're witnessing now is going to accelerate new technologies for decarbonization. Europe, that does not have any real significant amount of energy, is going to accelerate their technology for decarbonization. At the same time, they're going to invest in LNG plants so they can get gas from other sources in Russia. So all of this will play out. BlackRock is just as engaged working with every hydrocarbon company as we are trying to invest in new technologies. We believe many of the solutions are going to be with the hydrocarbon companies, not against. And so this is one of the things that I've very much enjoyed for the last 6 months, having dialogue, having roundtables with the CEOs of the major hydrocarbon companies to try to learn from them. And how do we see this transition moving? What are they doing about it? How are they focusing on things like decarbonization, sequestering of carbon? All of these are really great opportunities for investors. And so we see this as a major opportunity. This is not something that we're frightened of. This is not something that we are shocked upon, but we BlackRock have to play a role in trying to make this transition fair and just, and that's what we're trying to do.
No, that's excellent. Thank you. And then you just mentioned something, and you alluded a little bit to it, which is this concept of stakeholder capitalism, right? And we talk about how powerful stakeholder capitalism can be to really help society and shape society. And would love to hear a little bit from you of how your views are around stakeholder capitalism, and how does this evolving in the future, you believe?
Well, I would say we probably witnessed the greatest example of stakeholder capitalism, maybe in our lifetimes, in the last few weeks. The response of private companies of leaving Russia was all about stakeholder capitalism. When you think about companies are walking away from Russia, going to be taking charges in the first quarter, they did it because their employees were saying, "What are you doing there? This is immoral." Our clients worldwide are calling us, "How can you do business there?" And these companies moved out of Russia with such speed. To me, this is the greatest example of stakeholder capitalism, that you're listening not just to your shareholders, you're working alongside your employees, your clients. You're working with the communities where you work. You're responding to those communities. And as a result of that, I do believe these companies, are going to be better off. And I do believe this is pretty existential when you think about the speed in which stakeholder capitalism has evolved, but more importantly, the speed in which we saw the response by private sector companies. They weren't forced by governments, by the way. This was not sanction-based. This is a behavior-based by leaders of companies and their board, suggesting that they no longer can justify business in this aberrant country at the moment. And I do believe this is a wake-up call. This is a wake-up call for every government in the world. This is a wake-up call for every country in the world. The power of stakeholder capitalism is growing. And when you see aberrant behaviors, you can see big changes. This is why, as I said earlier, I think more and more companies are reevaluating their dependencies. And this is all part of stakeholder capitalism, that more and more companies are following the wishes and the needs of their clients, their employees, their community. And those who are following those needs generally have much more durable profitability, and we, the shareholders, are the biggest beneficiaries of that.
Yeah. And that leads me to my last question, really, which is around purpose, right? And how companies need to think more about their employee base, how employees having more of a voice. What would you, as a leader of a company with 20,000 employees, speaking to many other leaders, what are your recommendations? How do you see that evolving? What do corporate CEOs need to watch out for? What's coming down their way? We see now, as you mentioned, that happening with the conflict that we're seeing in Ukraine and Russia. What are companies need to look out for in this purpose game?
Well, I think every company has to have a purpose. Why do they exist? And that has to be understood by all employees. The corporate purpose is what unites your employees. If you don't have a mission, a purpose, it's hard to have a unified group of employees you want your employees to believe in you. And when they believe in you and they believe in the firm's mission, the employees work harder. And then they communicate that to their clients, and the clients understand the responsibilities and the foundational principles of that company. And so, to me, your corporate purpose is the essence, what resonates out of a company. And I think every company has to determine what is their purpose, but they have to live it. And if you live it every day with consistency, and by the way, a lot of companies don't live it every day with consistency, but if you live it every day with consistency, it emanates and allows you to be identified who you are, and your mission statement is not hijacked. We're living in a very polarized world. We all know that. And, we at BlackRock, I personally, are being attacked in the far left and far right. The positive side of that is some people in the far left and right don't like our voice or my voice, but the reality is our clients like our voice. And so the reason why we are willing to have a voice, or really to stick our head above the ground, is because we believe we're doing the right thing. We're doing the right thing for our employees. We're doing the right thing for you, our clients. We're trying to do the right thing in every community where we operate, and all of that will benefit our shareholders. And I am a firm, passionate believer that purpose is a characteristic that really emanates from each and every firm, and that characteristic is allowing that firm to move forward. And I would say, in this polarizing world where you're being attacked all the time, you have to have consistency of voice. Excuse me.
No problem.
Mr. Capito. Anyway, excuse me, everyone. But to me, that's what resonates, having that purpose, being involved. And to me, this is what, for me, that's my mission too, as the leader of BlackRock, to really making sure that we all have this unified purpose.
Mm-hmm. Larry, I think our time has come to an end. I want to really thank you for making the time. And also I wanted to thank you for BlackRock and your commitment to LATAM. You're traveling quite often with me to LATAM. Mm-hmm. And I look forward to going on a trip actually very soon to Mexico.
We're going sometime in the next few weeks. Good.
Yeah. Excellent.
Look forward to seeing all of you. Everyone stay healthy. We didn't even, can you imagine? We didn't even talk about COVID. My word right now, COVID. This is the first time I mentioned it. 6 months ago, that would have been front and center. That just tells you how the world has changed and reshaped.
Yes. Thank you, Larry. Take care. Have a great weekend. Bye. So as you heard from Larry as well, sustainability and ESG is really something very important to BlackRock. And I would like to invite you now to watch a video on sustainability coming your way.
Many thanks, Larry and Dominic, for that excellent start to the event. I'd just like to take a moment and offer an apology to some of our Spanish viewers who might have had a bit of background noise at the beginning of their feed. We're going to keep the content going, and we are now going to go live to Santiago de Chile and to London for our next session. Our speakers are going to be discussing market approaches to geopolitical uncertainty. I'm very happy to introduce you to Wei Li, Global Chief Investment Strategist at the BlackRock Investment Institute, and Axel Christensen, BlackRock's Chief Investment Strategist for Latin America. Over to you, Axel.
And then when we get to the point, you just wrap.
2,
Yes.
1.
Exactly. And then I left. I do mention, kind of, because halfway or even past halfway, we probably won't have mentioned China. So I just want to give you the option if you want me to ask you about it, or we should continue.
I'm happy to leave China out. In fact, looking at the list of questions, you go with the order that you have, and I think we probably stop before we get to the sector bit, and that's absolutely fine. And then, let's say, we keep going the dialogue between the two of us, and then by the time it gets to 3 minutes left of the whole session, you just pause, you just wrap.
Yeah. Okay.
Let's do that.
Okay, guys, we start in 5. Start, please.
Hello, my name is Axel Christensen, and welcome to our 10th anniversary of the Latin American Virtual Forum. I am quite honored to be joined today in our presentation, where we are going to be talking about how the global geopolitical uncertainty is affecting markets and economies by our very own Wei Li. Wei, she is the global investment strategist at the BlackRock Investment Institute here at BlackRock. So with that, Wei, let me, before we get into our conversation, perhaps kind of go a little bit through some of the points that Larry mentioned in the prior session that I think are worth repeating or highlighting. Definitely the recent events have been reshaping our global economy, geopolitics, the way we invest, and making us rethink so many things. And even before the conflict in Europe with the pandemic, we were seeing how supply chains are being affected. Companies are thinking really hard on how they redesign the way that they sell or produce goods or services, and that's producing a lot of challenges, but also a lot of opportunities, certainly for countries and their economic policy leaders as well. And of course, this is providing us with a lot of challenges. And finally, I just want to highlight before we initiate our conversation how Larry really kind of marked how important the recent events in terms of kind of really sinking down on a central theme at BlackRock, which has been stakeholder capitalism. But I'm going to leave that to Larry to just let us focus a little bit more on what's going on in terms of the economy. So of course, the recent events and the uncertainty that these events generate have created a lot of confusion and are reshaping both the global economy and politics whatsoever. And two important conduits of that happen to be inflation on the one hand, as well as economic activity. So can you please provide us with BII's general view on both, on how we see inflation and activity in the world? And certainly, let's start with our own theme for this year, living with inflation. So why don't you introduce us to our thoughts around that? Go ahead, Wei.
Absolutely. Thank you. Thank you so much, Axel, and welcome everyone to this flagship event. So indeed, there have been extraordinary events happening so far this year that is fundamentally changing the macro landscape, and of course our hearts and thoughts first and foremost goes to everyone being affected by the tragic war in Ukraine at the moment. And what we're seeing right now in Ukraine really represents a supply shock on top of an existing supply shock already that was very much related to the restart dynamics, because the supply is not switching on fast enough to meet the demand that is coming back online. And we already had a heightened inflationary pressure coming into this year. And the tragic war in Ukraine is just adding further the supply shock on top of supply shock, and specifically the transmission mechanism through energy, through agriculture, through other commodities. If you think about Russia representing 10% of the global oil and 17% of global gas. So all of that, the events so far this year represents actually inflation will be here to stay. It's rising higher. Our expectation for inflation for this year is higher, and also it means that it actually will settle at levels that are higher than what we got used to pre-pandemic. So specifically, we have been, Axel, to your point, advocating this theme called living with inflation for quite a while now. I would think almost 2 years that we have been kind of advocating the theme that inflation is coming. And for a while, the reason that we believe inflation would settle at levels higher than pre-pandemic levels is very much in recognition that economies have taken on a lot of debt during the pandemic. And as a result of that, when interest rates are low, these debts are affordable, they are serviceable. But interest rate starts to rise, and if rates starts to rise aggressively, then the serviceability of this debt becomes questionable. And that is a bigger problem than, in some cases, even fighting inflation, which is why we believe that rates would rise, but it wouldn't rise significantly beyond neutral rate. And that actually creates a path for inflation to settle at a higher level compared to pre-pandemic level. And now on top of that, we have the supply shock coming from the war in Ukraine. So all of that just to say, we entered 2022 with the expectation that inflation would be high and settle at higher levels than before. And now that has been further reinforced by the war in Ukraine. And in terms of the growth dynamics, the war in Ukraine obviously would represent a growth drag, but the read across per region is different depending on the economy's vulnerability. And I can go into that in greater detail later. But worth bearing in mind, even though the shock from the war in Ukraine is stagflationary in nature, it does not need to lead to stagflation, because the backdrop against which we entered 2022 was one of robust economic activities. The growth backdrop was reasonably strong coming from pandemic when things are all starting to switch back on. So we have a bit of a cushion in global economy to withstand some of the growth shock, but then again, the regional read across can be different.
Great. So definitely we're looking at a scenario where, yes, there's caution around, as you mentioned, the risk of stagflation, but not necessarily, that we're condemned to, fall into that situation because of this stronger, initial point, if you will, in terms of how the global economy was withstanding what was going on in terms of the restart. So now, of course, I would say that the recent events are, as you touched upon, making things different in different regions. Europe is being definitely hit harder because of their, closeness to the conflict, to their dependency on Russian fossil fuels. It seems for the U.S., the situation might be quite different. They're less dependent. The U.S. is much more efficient than it was years ago when it went through the last oil shock. It's also much more dependent on its own production. So how do you see those differences, evolving, and as an investor, does that have any repercussion?
Absolutely, Axel, you're spot on in that the read across of what is happening right now through to Europe, through to the US is really quite different. And that is in part why we recently pivoted in our asset allocation slightly away from European market, European equities, and slightly more towards the rest of developed market, including the US and including Japanese equity market. So specifically, we have done this exercise of trying to quantify the impact of the war in Ukraine and the subsequent energy price volatility and also the subsequent broader supply constraint to try to understand what it would actually mean for growth. It would actually mean for inflation, and also it would actually mean for asset allocation. So specifically what we did was to assume oil price would stay at an elevated kind of range of $100 to $130, given that our base case for the event on the ground would be protracted standoff. And at the same time, our assumption is for European natural gas to stay within the elevated level of 105 to 115 euro. So that's the kind of the assumptions that went into this exercise, and the and the impact on growth. The upshot of this exercise is that we expect that sort of environment to present a growth downward drag to European economy up to 3% this year, and also pushes up inflation for this year by 1% to 1.5%. But the equivalent number for the US economy actually is a lot more muted. The same assumption in terms of elevated energy price volatility translate into a more muted growth downward drag for the US economy of about 0.5%, and it would push up US inflation by about 1%. So part of that is exactly what Axel you already spoke about, which is that European energy dependency on Russia is a lot more compared with the US, right? So earlier on we talked about Russia representing 10% of global oil, but in terms of European energy dependency on Russia, in terms of oil, coal, and gas, we're talking about 27%, 47%, and 41%. So European economies are a lot more heavily reliant on Russia energy export in comparison with their US counterpart. And at the same time, European economies are more energy intensive, right? So if you think about the cost of energy as a percentage of GDP, the number is 9%, more than 9% in Europe. And the equivalent figure of energy intensity, the cost of energy as a percentage of GDP, is less than half of that of Europe. So the equivalent number in the US is 4.4%. So all of that is why we see European economies being more impacted by what is happening in Ukraine than the US economy. And I guess against that backdrop, it is no surprise that the latest 7.5% euro area inflation, out of that 7.5%, actually 5% of that is energy and food related. So this very, very intense kind of reliance on Russia and in the case of Europe is why we see greater vulnerability of the economy for the rest of the year. And this is also why when we look at earnings forecasts for European equity market and we compare that with the US, we see actually, yes, indeed, both Europe and US entered 2022 with its equity market forecasted to deliver and grow earnings by high single digits. Right now, European equity market earnings per share forecast has been moderated down to mid-single digits. So from high single digits to mid-single digits. But we don't think that downward revision is enough We think that given the macro vulnerability that I just talked about, actually, it's entirely possible that European equities do not grow earnings at all this year, right? So further downgrade to come, in our view, for European equity market, which is also why we're currently, we pivoted away from European equity market a bit in the recent Q2 second quarter outlook. And the equivalent earnings growth for the US equity market, it entered this year, same as the European equity market, with a high single-digit earnings growth expectation. Right now, it's still holding up at high single digits earnings per share expectation. We think that there is room for that to marginally come down. But given the fact that for US equity market, more than 2/3 of the revenue for S&P 500, actually, for example, are derived from within the US border, we do think that the equity market, similar to the economy, is reasonably protected and shielded from the geopolitical uncertainty in Ukraine, the war in Ukraine. And as a result of that, again, it supports this pivoting away from Europe and towards US in our equity allocation at this point. So this is currently how we're seeing the geopolitical uncertainty, the war in Ukraine impacting Europe, and also how its impact is very, very different in the case of the US. But Axel, you are the expert in Latin America. How do you see emerging markets more broadly in the current scenario? And also, how are the economies in Latin America in particular fighting and handling inflation? And how is the growth picture holding up? And tying that into the overall reshaping theme that Larry also mentioned.
Certainly, Wei. And very much so, emerging markets, as you described, the difference between the US and Europe is pretty much also the characteristic. You have emerging markets, especially those in Asia, which are very much more dependent on consumption of a lot of the commodities that you mentioned have risen in price. Of course, energy, food, industrial metals. So that impact, although much more diluted because the dependency is lower than Europe, it is definitely going to be an obstacle for growth for the restart. Although again, much more muted than in Europe. But at the same time, you mentioned Latin America. It definitely provides pretty much kind of an unexpected opportunity, at least in the short term, to see those commodity prices stay higher for longer. Now, it is a mixed situation. Although many of the economies in Latin America, be it oil, be it copper or crops, are significant contributions to economic activity. At the same time, they're also having to deal with quite high levels of inflation. And not just now, since last year. So central banks are pretty much way ahead of what has been going on in developed market central banks, such as the Fed or the ECB. So that is already taking a toll on economic activity. So it's kind of a balance. Quite more positive with this higher commodity scenario, a super cycle, if you will. We can talk a little bit if this is more structural or just responding to the current events, but also having to confront kind of central banks putting the foot on the brake to contain these inflationary pressures. We're already seeing that flourish in some of the recent figures, or even more so on what central banks have been doing in terms of the forecast, be it the Central Bank of Brazil or more recently here in Chile. They're, as we mentioned, they're pretty much acknowledging that they will have to live with inflation for some time higher, meaning that probably they won't be as aggressive as they want to, because they don't want to necessarily push their economies into a very bleak economic activity situation. So they'll have to kind of content themselves with inflation sticking around for a little bit longer, but yet, looking out for those longer term inflation expectations not to be de-anchored. A very, very difficult balancing act that we'll see from a lot of the central banks in the region. So I guess it's not an easy time to be a central banker, and less so, I guess, an investor. So the question back to you, Wei, and related to economic policy. What are your thoughts? What has BII thought about, the policy response from the Fed or the ECB in this higher inflation situation, but with the uncertainty that the recent events have brought?
Absolutely. Actually, Axel, you're absolutely right in that Latin America has actually done really well so far this year in terms of the asset price, because even though the food inflation makes up a bigger percentage of emerging market inflation prints, Latin America being exporters of some of the commodities being impacted have had a bit of an offsetting factor, which has supported the market. So that's a great point. So to your other question, to this question about our view on central bank response mechanism in light of this supply shock on top of supply shock, I would just actually take a step back and say, what an incredible year-to-date repricing in fixed income market. 1 year ago, we're looking at one rate hike until the end of 2023 for the Fed, and now we're talking about every meeting delivering a rate hike, and maybe once or twice for this year, we have 50 bips of rate hike in the case of the US Fed. And for ECB as well, right now, entering 2022, the expectation was that, actually, we're not going to talk about rate hikes for this year, but now 2 rate hikes are being priced in for this year. And from now until mid next year, we're talking about potentially 6 rate hikes out of 8 meetings. We're talking about really very, very meaningful turnaround in terms of a hawkish repricing on the front end in terms of rate hikes by big developed central banks, developed market central banks. So in our view, what we're seeing right now represents more of a bringing forward future rate hikes. And what really, really matters in our view for risk sentiment and also for asset allocation is the cumulative number of rate hikes for the entirety of this cycle, because that ultimately determines your long-dated discount rate as you think about discounting future cash flows for profitabilities for companies. So what we really, really care about is the number of cumulative rate hikes for the whole of the cycle, of the rate hiking cycle. And that has not moved as much as the pace at which rate hikes are being brought forward. So that's the first observation that I would make. The second observation is that we think that it's absolutely justified for central banks, for developed market central banks, in this case, we just talked about the Fed, we talked about the ECB, for them to get closer to neutral, for them to squeeze out the additional stimulus, the additional easing in the system, because we are at a point of the restart from the pandemic that actually does not need additional stimulus. It does not need the huge amount of monetary and fiscal coordination that we saw in 2020, 2021 that allowed the economy to bridge to a point where we can think about the future. Right now, we don't need that anymore. So for rates to get very quickly closer to neutral rates is absolutely justified. In fact, the faster we get there, the less inflationary pressure we have from the easing side, and that is a good thing. And then that also gives them a bit of flexibility to act as they wish should situation change. But going significantly beyond neutral, going aggressively beyond neutral, which is what the markets sometimes are suggesting, seem to be expecting. And in the case of the Fed, they are even signaling more rate hikes than the neutral rate, above which is tightening and below which is easing. So they are signaling more rate hikes than what we think is warranted, given that we think neutral rate is what they ought to be targeting, and that is the key. That is the key. our view is that we don't think that they can go aggressively beyond neutral rate because given the nature of inflation that we're seeing that is driven by supply bottlenecks, raising rate is not going to help solve supply bottlenecks in China. Raising rate is not going to help with the COVID situation in the rest of the emerging market that is causing the supply chain issue. Raising rate is not going to help solve the war in Ukraine that is fundamentally a very, very very kind of geopolitical nature of a event. But what raising rate aggressively beyond neutral rate can do is to hurt the economy and to hurt the labor market. So by our estimate, in order to bring down inflation in the US to close to trend, actually, if we were to do that aggressively through raising rates alone, we could really risk pushing up unemployment rate to almost double digit, which will be a huge cost. And at some point, we believe that central banks will be faced with the dilemma. Are they willing to be so, to sacrifice the economy and the labor market in order to seem very tough on inflation? We believe that they would not do that, but right now they are seemingly talking tough on inflation because that is the politically correct thing to do. But ultimately, we do not believe that they can see through the number of rate hikes that they signaled for the entirety of the cycle. And this view that I just described is what actually underpins our broadly still constructive view on risk assets globally, especially in developed market equities, because we believe that the Fed will get very quickly to neutral rates, and they signal that they will, but they wouldn't go aggressively beyond neutral. And that is ultimately still a constructive kind of backdrop for risk assets.
That's a very, very interesting insight, Wei. And before we do transition into the next topic, let me just comment in terms of perhaps how, unlike kind of the normal situation where typically emerging market banks and certainly Latin American central banks would look at the Fed or ECB in terms of looking at what the pattern towards forward policy movements might be. We might be in the reverse situation where the playbook is actually coming from emerging markets, where the Fed could eventually see the risk of going too far beyond that neutral rate. Certainly that is the case in Latin America. As I mentioned before, where it's already having a toll on economic activity. And although it hasn't showed up as strongly on employment numbers yet because of the more lagging nature of it, that is the concern that, too much rate hikes or too strong of doses to contain inflation at a certain point starts to hurt economic growth. So if anything, hopefully this is not common, I would expect, for developed market central banks to look at what's going on in places like Brazil, like Mexico, or other emerging markets, to get a sense of how much more should they deliver, at what point should they kind of rein in their language to make it more kind of in sync to their actual movements going on forward. So this is going to be very interesting how this develops over time, certainly in terms of also how much of the credibility of the Fed or other central banks is also at stake. And again, that maintaining long-term inflation expectations anchored is going to be key around that. But as I mentioned, I want to transition to one final topic, which also Larry mentioned. And of course, this also has been one of the key themes not only for this year, but also for some time now, which means, we call it this year navigating towards net zero, and how the climate transition, is being certainly affected by the current events. But I think the audience is curious what BII's take on this. Is the conflict, what's going on with these spikes in oil prices, is that going to be an obstacle for climate transition, or is something else going to happen?
Well, actually, potentially the opposite. What we have seen so far is that Europe has signaled its willingness and desire, strong desire to wean itself off reliance on Russian energy supplies. And in our view, that actually probably will reinforce the net zero transition in Europe. So the way that we think about it is that actually the energy shock, the energy price volatility is a bit like a carbon tax, right? So that in comparison makes renewable energies even more competitive in the case of Europe. But again, in the same way that the impact on growth and inflation is very different in Europe versus the US, the impact on the net zero transition is perhaps also a bit more nuanced in comparison, comparing Europe and the US, in that whilst it's acting as a bit of a, in our view, accelerator for the net zero transition in Europe, the US probably wouldn't feel as strong a push as the Europeans do, because at the end of the day, the US is a net primary energy exporter. And in fact, in order to make up for the decrease in energy imports of Europeans from Russia, the US will have to increase production in order to compensate for the reduced Russia supply for Europe. And as I said earlier, the US has a lower energy cost burden, so it feels the pressure a bit less. So combining an accelerated Europe, but more nuanced picture in the US, we do feel on aggregate, perhaps the pace will push on at the same pace, if not faster, versus before. And what that means for investing is that as we think about navigating the net zero transition, having exposure to both the traditional energy stocks that are doing well in the short term because of the greater need for additional non-Russia supply, but also having exposure to renewable energies that are also performing well because of the need to transition towards them. So think about kind of combining both sources of energies in portfolios and thinking through them in terms of different shades of brown and different shades of green is very important.
Yes, if I can add before we're about to conclude our session, just add on how these higher energy prices are actually putting additional pressure, be it on companies or economies that depend on fossil fuels, to make the investments that allow them to participate in the transition. Until now, there was the perfect excuse. These low oil prices do not allow me to make the investments to go from that dark brown to a middle tone brown and eventually to green. Now there is no excuse, right? So oil exporting countries or companies should see this as a signal, this windfall profits that they will receive, as the moment for them to make the right decision. So Wei, thank you very much. Let me just briefly wrap up. I think we've covered a lot for our only 30-minute allocation to the session, starting from what we're seeing in terms of the inflation and the economic activity landscape, how the recent events have had distinctive effects, be it in Europe, that probably pushes it closer to a stagflation type of scenario, whereas other regions are much more, separated from that because of their distance, but or dependency for that matter, or because of their own capabilities. In that sense, in emerging markets, of course, challenges, stronger inflation leading to central banks hiking rates, but at the same time, perhaps seeing another super cycle for commodities that helped bring growth several years past. So in terms of that positive response, we're seeing the Fed probably talking the talk much more roughly than what eventually the walking of the walk that they will finally conclude. But again, divergence between what the different policy responses will be because of the impact on activity, as well as inflation. And then finally, how the recent events, rather than posing an obstacle, a deterrent to this long-term climate transition trend that we've been bringing forward to our clients for some time now, actually serves as an accelerator. Certainly for Europe, perhaps not so much for the US. And here's the call as an investor to look at traditional energy and renewable energy as kind of a nice barbell in terms of risk and opportunities. And finally, for Latin America, strong opportunity, certainly for commodity intensive industries, and not only in energy, but also in industrial metals. So with that, let me just thank you very much, Wei, for your participation in today's session in our virtual forum. And back to you, Nicholas.
Thank you, Wei and Axel. That was wonderful, really insightful. We all enjoyed it here. Now that we've heard a bit about the different market approaches to all this uncertainty, we want to take a look ahead, looking forward to see how we can react and respond to this with our investments. We're now going to go live to two places, New York and Florida, where we'll be hearing from Cindy Shimoide, Head of Portfolio Consulting for Latin America at BlackRock, and Rick Reeder, CIO of Global Fixed Income and Head of Global Allocation at BlackRock. Cindy, Rick, it's over to you now. The audience is all yours.
Start. We're on. Start.
Hello, everyone. My name is Cindy Shimoide, and it's my pleasure to talk to you today and to Rick Reeder. Rick is responsible for roughly $2.4 trillion in assets managed by BlackRock. He's the CIO of Global Fixed Income and Head of Global Allocation Investments. Hi, Rick. How are you? I hear you're in Florida, sunny Florida.
I am, although not as sunny today, but I am, Cindy. Thanks for having me. Thanks for doing this with me.
Yeah, it sounds like we're all in a at least spring state of mind. So why don't we introduce a few topics of discussion? Rick, what's top of mind for several investors seems to be inflation. What are your views on inflation, this current inflationary environment, and how could we think about investing around that?
Thanks, Cindy. So, by the way, I mean, this is, you think about coming into this year, I mean, inflation was on everybody's minds coming into this year, but the war really changed that and really put it into just another level of what was, coming in this year, this idea that it was going to be sticky, and then all of a sudden, it's going to be sticky higher and with us for even a longer period of time. Actually, do you have these slides? I was going to put the slides up to show a couple of things, just to depict how significant the war has been and the influence that it's had. I think I should show those on the screen. Do you have those slides? anyway, I'll start talking through it as they pull those up. And the first thing, just to put some background to this, I mean, the biggest impact has clearly been on energy. But I'll talk about that in a second. But the impact on food, and just to throw out a couple of stats on this, I mean, which has been, I think, depicted by the media pretty aggressively recently, is 34% of global wheat trade comes from Russia and Ukraine. And things like sunflower oil that nobody ever would have, there we go, that nobody on the upper left, things like sunflower oils, literally 50% of global trade comes out of those two countries. And by the way, a series of other oil, vegetable oils, et cetera, and corn, which has gotten obviously a lot of attention in terms of the amount of trade. And I mean, actually, the stat that we saw recently, that actually 12% of the calories in the world, look at this in this green box on the right, 12% of all the calories in the world that are traded globally come from this Russia-Ukraine. It's like an extraordinary stat. And then obviously the influence on potash and nitrogen and potassium and the influence on fertilizers. And you look at where this war, these maps on the bottom, not going through them, show the impact that this war has had. Pretty dramatic. So you can't talk about inflation, and particularly you saw this in the last CPI report. You can't talk about inflation without mentioning the impact that's now starting to work its way in to things like corn and oil, vegetable oils, and obviously, tangentially what's happening to other forms of ag. If you go to the next page, just to build on this, say a bit more. People talk about the impact on energy and oil, and we watch, including today, we watch crude oil prices moving with incredible ways, and with oil staying above $100 a barrel. But I think it was interesting when you look at the upper left, just to put this in perspective and think about the impact it's having on inflation. Where I put that hatch circle, it's 8 million barrels of lost production from Russia, i.e. production that is not going to go to the normal places that it has. And I put those yellow arrows, and you think about the gap when you have obviously negative production relative demand in places like Europe, Asia Pacific, ex-China, and then China. So the question is, how do you make up for that? And people talk about Iran, maybe you get 1.5 million, 2 million barrels there. In the short term, the U.S. releases its strategic petroleum reserve. But at the end of the day, that 8 million barrels is hard to make up for, even if OPEC increases moderately. So the point being, oil prices as buoying inflation will continue. Then you see nat gas on just the right. We talk about losing 155 billion cubic meters of gas. And you see Europe, we're put in the pink here, you have this big deficit. So point being, inflation is really being buoyed and will continue to be so. You'll have this stickier inflation dynamic. I show, by the way, you look at the bottom middle. It's the first thing I was in the bottom left graph. You look at energy, you look at CapEx spend. There has to be additional spend on CapEx. And I think what you're going to see over the coming months and years is you'll see some both renewable and traditional CapEx and energy that has to pick up in order to bridge some of this gap. And then I just want to show this one chart on the bottom middle. And this is, I know we're going to talk about EM, but one of the tricky things in much of the world today is you look at things like oil in BRL or oil in INR and in Euro, and you see, how prolific these things can be in parts of the emerging markets when you get these spikes. So inflation is to be with us. And I had one more page I just wanted to touch on, just because inflation is such a big deal today, is if you go to the next page, just to put this in a perspective. So you look at, it's not just obviously food, energy, housing, but you look at the upper left and you look at one of the things that I think has got the Fed concerned, and that I think is clearly going to be an impact going forward, is you look at that green line, which is core services. You've got an acceleration of wages that is taking place. You see this in the employment report that we got on Friday. You continue to see this acceleration of wages. And then you look at supply chains and you think about China and lockdown and how do you get these supply chains unlocked, and then on the upper right, deglobalization. So listen, you can't even talk about investments today without talking about inflation. You look at the bottom left, you say, gosh, we're going to run for the next 3 months. You're going to run what is top line headline CPI that's going to be 7.5%, 8%. And actually the table on just the right of it shows that you're going to have headline CPI that's going to be through May, and then it'll start trending down. But boy, these are still pretty big numbers. And so, the one thing that I think makes a huge difference for the rates markets is look at the bottom right. And we looked at swap spreads. So everybody looks at 10-year real rates and says 10-year real rates and interest rates, we know they're rich and we know that rates should be somewhat higher. But if you think this inflation is stickier, we ran the 10-year treasury off of 1 year inflation, assuming inflation's stickier, and let's say, get inflation that runs at 4.5 or so for a longer period of time. Treasuries yields have to be a bit higher. The 10-year treasury at 240 doesn't make a lot of sense, when you're running stickier inflation for a longer period of time. So I don't think rates are going to, I know we're going to talk about it, I don't think rates are going to move dramatically higher. But boy, when you look and you stare at all this inflation data and you say, gosh, it's going to be stickier, deglobalization, supply chains probably with us a bit longer. My sense is rates have to elevate a bit more than we're at today. So anyway, I'll stop there, Cindy.
Thank you, Rick. Agree with you. Can't talk about investments without talking about inflation nowadays. But I would also like to talk to you about emerging market debt, because as you know, several of our clients may have a portion of their investments in fixed income. So how does emerging market debt play in the current scenario? And I wonder if you'd favor hard currency, meaning denominated in US dollars, for example, or soft currency, the bonds in the local currency. Because talking about foreign exchange, some Latin American currencies can be sensitive to commodities. Any thoughts for us investors in these markets?
Yeah, so maybe if you go, just to use as a backdrop, this next page, just talk a little bit about, listen, there's no doubt, you look at these graphs on the top and you look at, this takes the 10-year rank of where spreads and yields are in emerging markets, and both hard currency on the left and local on the right. So we're at the 77th percentile in spread and 89th percentile of yield. And then in local currency, you're at the 98th percentile over 1 year, 58% over a 10-year period. And then I show on the bottom that emerging market rates, have clearly been under some pressure because of developed markets rates. So what do you do with that from today? Listen, I think there's a few things that are causing some challenges around EM. By the way, we've added a little bit of EM recently. But, it's hard to see a window where EM does significantly better. You've got this inflationary shock we talked about that's uneven across emerging markets. You've got and particularly the oil shock, which is, benefits some parts of EM, but clearly a drag in terms of others. And then, the trickier thing is emerging market growth is still very uneven. And, you have this really difficult dynamic in EM where inflation is higher and the central banks are raising rates across much of EM to try and manage that. But simultaneously, you've got a growth paradigm that is slowing. So listen, I still think it's being a bit cautious around emerging markets, tactically add in some places. I'll talk a little bit about, hard currency. We prefer hard currency today. And, the valuations, we show on the upper left, these valuations are still pretty attractive. We expect that, you'll get a little bit, in the credit markets, you could get a little bit of compression around hard currency. And listen, I think local rates, I still think is going to be harder for a period of time. You've got a Fed that's moving and raising rates and probably buoying the dollar for a period of time. And so, EMFX has actually done pretty well recently. But gosh, I'd be a little bit cautious on local currency for a while. I tell you, it's pretty hard in my career. I would say when you stare at numbers and see something in the 98th percentile, pretty hard not to buy it. But listen, I think, I think we got to be a little bit conservative for a period of time, and things like credit. We like some of the investment grade parts of the credit market better, be a little safer, a little bit more conservative, and and then work your way into some risk over time. And so anyway, being a bit more cautious than we've been historically. The parts of LATAM that we've been adding to recently, and Mexico is one of those places. A little bit in Brazil, both in debt and equity, but I would say by and large, we are running. When you've got global financial conditions that are tightening, and the developed market central banks are tightening, and the emerging market central banks are doing that alongside of it. It's a time to we think to be a little patient, and then look at some idiosyncratic opportunities.
Agree. Okay. Rick, we're also going through such an interesting time in market where this typical correlation between bonds and equities in different interest rate cycles that you've mentioned, I feel like they may be playing differently this time around. So where else are you looking at in order to increase diversification in your portfolio?
So I brought some slides. I like to use slides and just to show some visuals and put in perspective. So this takes a bunch of markets from in the fixed income market, treasuries, the aggregate index, emerging markets, municipals, stocks, oil, gold, et cetera. And I think the color visual is I think very illustrative here in that you look at 2018 and you think about we were in an environment where the Fed was tightening and they were draining liquidity from the system, and virtually everything had a hard time. Debt, the bond market, the equity market, everything had a hard time. By the way, it's interesting, oil had a hard time, down 25%. As you know, you were restricting demand, or you were culling demand a bit, a little different than today. And then 2019, 2020, you had easier central banks. You had obviously the Fed being easy in 19 after it was too tight. And then obviously with the pandemic, very easy monetary and fiscal policy. And then I thought 21 was interesting in that you had, you still, by the way, look at the bottom line here. This is a 60-40 blend, which a lot of investors look at, 60% equity, 40% debt. And you actually still did okay in 21, but it was all because your equity did well and your bonds didn't. 22 has been hard across virtually everything. So, it's hard diversifying when you look at that 2022 line. And by the way, it's been a little bit better in March, the last column, where equities have done a bit better. But, it's pretty hard to diversify when everything is red, but except for oil and gold. By the way, part of it, depending on how you can diversify, I still think oil and commodities and agriculture are still going to be very well supported. So if that's within the investment remit that one has, I do think having some commodity, et cetera, exposure makes sense around diversification. If you go to the next page, talk a little bit more about this. And I think there's a lot of data on this page, and obviously if anybody wants these slides, some of the slides, but there's something really interesting. If you said to me on the left side, you said, gosh, what will happen to the stock market if 2-year interest rates went up 175 basis points? I'd say, oh, no, stocks have to go down. And by the way, I thought they would, because we had a view that rates could move higher. And anyway, the stock market did go down, and then it stopped and actually moved higher. And to your point, Cindy, about diversification, we are witnessing something. I think Business Insider just did a piece we did on an interview with them on that. I haven't seen this in a decade. That if you look at how much interest rates have moved back, 2-year treasuries, 5-year treasuries, where I put that red box, and then look at investment grade credit and high yield now getting to 4% yield and 6.25% yield. And if you look at the difference between yields and equities, that all of a sudden fixed income is starting to be interesting again after getting pounded for the last, certainly the last 12 months. And go to the next page just to build on this a little bit more. So if you break down, so this is one of my favorite charts. So this takes the earnings yield of the S&P 500 and compares it to functionally where we are versus history, and then to think about where are we? If you take where EM was, you look at over a 10-year time frame, S&P is at the 18th percentile, and the Nasdaq's at the 18th percentile. So not really cheap. Equities are not really cheap today. And so, do I think equities will still end the year up a little bit? And actually, if you go to the next page. You go one more page.
Wait.
Yeah, so I was going to show on this one page that actually, if you look at this chart on the upper right, and this really puts it into perspective. If you take the S&P 500 and you look at investment grade high yield, so this is the model that we run, where people look at PE ratios and they look at other metrics, price to book. My favorite valuation tool for looking at equities is looking at where are the valuations versus how much it costs companies to finance, i.e., if you were to borrow in the investment grade or high yield market, what where equity valuations are. And if you look at where it is all the way on the right side, this is the first time in a decade that equities are actually not cheap. In fact, they're rich relative to the credit markets. And if you look at the bottom chart, this is pretty incredible. This is the volatility markets. If you look at the MOVE index, which is the volatility of fixed income, of interest rates, versus the volatility of the equity market. So equities are performing really well. And one man's opinion that you can start to diversify, build a bit more balance of starting to take some yield now in a portfolio and use some fixed income with equities. So, and if you go to the next page, there's a bunch of data on this page, but I'll try and describe it in as simple a form as possible. If we look at the upper left, I think Morgan Stanley did this. They looked at where credit spreads have been during different periods where spreads in investor grade and high yield credit have widened. And the green line is where we are year to date. And we've clearly cheapened up. And it suggests we may go a bit further. But if you look at these charts on the top middle, similarly, we looked at EM. Investor grade credit is the 89th percentile of yield, 48th percentile of spread, and high yield is pretty reasonable. So one of the things, and by the way, Europe, without going through all this on the bottom right, Europe shows the same thing, 77th and 80th percentile. So, talk about diversification. We're buying some credit and we're buying some investor grade credit and quite frankly, holding it in yield to create a bit more balance in a portfolio. It's been all about buying equities, but I think today you can actually take some yield into your portfolio. And if you go one more page, I'll try and describe how we're actually managing this within our portfolios and how we think about this. Go one more page down. So if you look at this graph on the top part of this page, this takes carry to volatility. So, within a portfolio, I think about, gosh, how much volatility am I taking in? How much carry am I getting? Look at the red bars versus where they were a year ago. The 2-year treasuries were at 0. If you think about, we were at negative rates in Europe. All of a sudden, I can get. Look at that bar on the left. 2-year treasuries, and I'm looking at the ratio of how much volatility and our carry, and then look at things like 3-year investor grade credit or 1 to 3-year European credit. And people say, well, I don't know, short-end interest rates have gone higher, but look at the table on the bottom. The 1 to 3-year ag is only down 260. The 1 to 3-year corporate's only down 256. The long corporate's down 12%. Meaning, if you said where are rates going, I think rates are going higher. I don't think they're going much higher, but I think they're going higher. But boy, if I can carry through the end of the year owning some of these yielding assets, try and take some credit spread, maybe shorter on the yield curve. And then finally, my last page is, if you go to one more page, so, by the way, I was using this analogy on a call I did last week, where I feel like I said a little bit of like being a security guard, not like securities, but like, you get paid. Think about a security guard, you're sort of watching a lot of screens. You're getting paid for waiting, and then you jump into action when you need to. I quite frankly think it's a pretty good analogy today, a pretty good metaphor today for, I just want to get paid for just watching for a bit. And meaning if I can own, what I put on the top part here, treasuries 1 to 5 year, if I look at the percentile, they've been 90th percentile in the last year, and the percentile of quarterly returns since inception, meaning 90% of the yield available and 1% of the return, meaning, boy, some of those assets have gotten pretty cheap. So if I can own some of this 1 to 5 year treasury, some municipals that can do that, some credit 3 to 5 years, and then be a bit patient and just get paid for watching for a bit, and let the market stabilize, let the Fed finish. I think the Fed's going to go 50 basis points in May, 50 basis. I think they'll go another 50 in June. I'd like to keep my interest rate exposure down, keep my yield at a reasonable level, sit in a lot of cash, and then wait for another time where I could take on a bit more risk, things like EM, like we talked about. Let the Fed, get out what it needs to get out. It's got to talk tough on inflation. It's got to act tough on inflation. And so in the interim, I just want to get paid for taking some carrying of the book and being a bit deliberate for a period of time. I know it was a long answer, Cindy.
No, thank you, Rick. I think we're we're definitely talking a lot more about fixed income nowadays, but I sometimes also feel like it's hard to have a conversation on investments without touching on Chinese bonds or equities. So, in your view, how can China exposure contribute to a global portfolio?
So if you go to the next page, so China is one of the most. If you said to me, and I think I said this in a LATAM conference a couple of years ago, and I'm probably still going to say this. If you said to me, I could use one piece of information. Well, now maybe it's a little trickier because of the Russia-Ukrainian dynamic, but let's say that aside. If you said there's one piece of data I could have at the end of the year, what would it be? I would say, tell me how China's growing. Tell me alignment, with Russia and or not, because that's a really tricky dynamic. How the property sector is going to do, how the COVID dynamics are going to play out, the election, the Xi election at the end of the year. Boy, there's a lot going on there. And to your point, it's such a big part of the global economy, such a big part of global trade that you have to have a view. And so good at what I put on here in the upper left, something that I thought was pretty interesting is, these are the COVID cases. Actually, I looked at something today, which actually blew me away. I went through this on a strategy call, that up to 80% of China is now being impacted in some form by lockdown. I was actually blown away by that, by that piece of data. That seems high to me, but we heard some numbers that were being impacted around lockdown. But, it's interesting when you study the data on the top middle and look at this is a congestion index, i.e. travel or business confidence index. They haven't come off that much, surprisingly. But you look at the bottom right, bottom left, you look at the Chinese stock market, although obviously having bounced, and you look at GDP forecast, Bloomberg consensus for GDP forecast, and you have it in activity scores. So, what do you do with that today? Listen, I think there's something pretty important. We are more enthusiastic than most on China, on the amount of policy that's coming in China, and how what that policy, fiscal and monetary policy, are going to do. And obviously, you've seen some significant regulatory change in terms of some of the recent commentary. So, listen, I think we have a saying within our portfolios. We've trimmed back some of our exposure in both credit and some of the equity over the last year or so. We haven't added a lot, but I think tactically, looking at parts of the technology sector and equities, which, like I say, has gotten some better play out of policy in terms of the regulatory dynamic. I think Chinese rates. I read a piece this morning that I thought was pretty fair about think about what part of the world is actually easing now, and China has the ability to do it and is actually doing it. And so Chinese rates can definitely play a diversifier, stabilizer in your portfolio of fixed income. Well, I think U.S. rates are going higher. I think European rates are going higher. I think certainly central banks in EM are moving rates higher. China's a pretty interesting from a rates perspective, pretty interesting. And by the way, inflation, it's the one part of the world where inflation has stayed relatively contained, pretty well contained. So maybe a bit of Chinese rates. Picking away at some of the equities over there, I think makes some sense. But more than anything else, if you're investing in China or not, if you don't have your eyes on it, then I think you're missing the investment paradigm and certainly the growth paradigm and the trade impact in the world today. It's just such a big. And by the way, commodities too. While in our portfolios we have been long, we like being long things. We talked about things like metals, the coppers, the iron ores, the aluminums, nickels. You got to be really intent in terms of your focus on China to have an opinion there. And like I said, because I think growth is actually stabilizing and will improve, it gives me some comfort around some of those commodity positions as well.
Thank you, Rick. You mentioned briefly while talking to China about technology. I want to go deeper. We have a few more minutes, but could you share with us your thoughts on how technology is leading this next wave of investing and how sustainability plays a role in this future?
So I don't have any more slides, but listen, I think we are going through, and by the way, I think part of what this war has done as it has driven this growth of technology and sustainability to just the next level in two different forms. So you think about, gosh, there's a near-term impact that's going to create some CapEx spend in some of the traditional forms of energy. But boy, you talk about the acceleration of climate, of renewables, and the spending there, infrastructure spend. I mean, Europe is going to spend. We've tried to sensitize how much Europe it could spend in each country in terms of fiscal spend and where it's going to come. Climate, energy, infrastructure, obviously immigration. There's a lot of money that's going to go in. And I would argue sustainability, technology are going to be the epicenter of this. By the way, then you look at things like commodities we talked about increasing, or ag. We spent a bunch of time in things like efficient agriculture, precision ag. There are companies like Deere, Caterpillar, a number of companies that have become, really, really good at technology and logistics related to agriculture. And so that to me is also in and around sustainability and efficiency. By the way, there's a number of companies as well that think about GPS technology. And you think about what just happened, whether it's war or otherwise, things like GPS technology that give people a sense for crop efficiencies, mobility, logistics, defense. And so, expenditure in these spaces is gonna continue to grow. And I will throw out one last piece to this, Cindy, is part of why I still think people have thought about NASDAQ's down this year, or tech, or some of the high flying tech is down this year. Well, if you don't have one eye on technology over the next few years, and by the way, you're getting some better valuations. You think about with wages accelerating. I know from a number of companies or CEOs I talk to, think about, gosh, what do I need to do in AI, robotics, cloud? How do I make my business more software? How do I make my business more efficient, more costs? My margins are getting compressed, wages are going up, my input costs are going up. I got to be more efficient. I got to make sure I'm spending on software, cloud, AI, et cetera. And so I think there's some really cool opportunities in and around tech, sustainability. But like I say, there's some places clearly, there was some rush to some of the high flying tech over the last few years. And so, you've gotten some repricing in an aggressive way. And by the way, some of it is still priced too high. I mean, I still look at companies that are 10 or 15 times revenue. I'm like, still not there. But boy, we've spent a bunch, including this weekend, looking at a bunch of these places that we talked about and trying to find, who's cutting edge in AI, who's cutting edge in mobility, et cetera. And so, my sense is that's going to be a bigger and growing part of your investment paradigm for the foreseeable future.
Thank you, Rick, for this very insightful session. We talked about how we can adapt our multi-asset portfolio in this inflationary scenario. Rick mentioned deglobalization and the global supply of energy that could be a consideration. Within fixed income, when holding emerging market debt, I think we're paying attention to select hard currency exposure. We can also expect volatility in the scenario that has impacted commodities. Lastly, we also heard from Rick that credit opportunities can be considered in today's possibilities of investments, the role of China and technology as well. This has been great, Rick. Thank you. I was thrilled to be with you in the last 30 minutes. Thank you, Rick. Thank you, everyone.
Thanks for having me. Thank you.
Hello again. I'm back from a slightly different vantage point. I just wanted to say thank you both to Cindy and Rick for that incredibly detailed presentation. I'm sure that our audience really enjoyed it. I'm now going to be joined by Sergio Mendes, country head of Mexico at BlackRock. Sergio, it's nice to actually talk to someone for the first time today. I've been very isolated all day. I was hoping that you were going to be sitting here beside me, but circumstances got in the way. Anyways, it's great to have you. It's nice to have someone from Mexico as on to close off day one of the event. And I wanted to ask you if you could sum up a bit of what we've talked about today and what that means for investors around Latin America and Mexico.
Well, Nick, thank you. There's definitely on these 2 years has been a completely learning curve and how to be flexible. So we need to adapt. No, so I think that is of course the theme. But again, as Nicolas was saying, I am Sergio Mendes. I'm glad to be here. I'm the country manager for BlackRock for Mexico, and we really hope you have enjoyed this first day of our Latin American Virtual Forum. During this day, we heard from Larry, I think, important things like, the access to capital is not a right, it's a privilege. So, and how the geopolitical will be reshaping our world. Big winners, where Mexico sits, as Larry was pointing out, and some losers as an isolation of the globalization is real and it's here. Inflation, we hear all, in the 3 meetings that it's a reality, and disruptions will continue. So we will have to adapt to this new world because some generations haven't lived yet through inflationary periods as we are doing right now. Over $100 a barrel on oil definitely will reaccelerate or accelerate decarbonization, and that's definitely an opportunity. Transition from brown to green has to be fair and has to be something, and that creates the opportunity. Also, Larry was pointing out about the company's purpose and how we have to define it and to live through that, as well as the stakeholder capitalism. On our second session of the day, we heard from our BlackRock Investment Institute, Axel Christensen and Wei Li. Of course, inflation is here to stay, and how central banks are reacting and how different central banks are moving in different speed. As of now, no signals of stagflation yet, but definitely something to be careful and to have and to bear in mind. Impact on the European region, definitely it's important. And of course, the opportunity which lies in LATAM, with central banks hitting the brake already, but making some adjustments to adapt to this new environment. A quick environment, definitely, which is changing constantly. And our third session, we heard about Cindy Shimoy and Rick Ritter also talking about inflation and how the portfolio should adapt to that inflation. It seems that 7.5%, over 7.5% in developed countries will continue for a while. It's a big number, and the impacts on the emerging market debt. So you got to be careful looking at it and see how are the reactions. Of course, fixed income is looking interesting again against an expensive, equity markets, and China rates are attractive. I think that those were the main themes that we went through these 3 first sessions of the first day, but also a constant was sustainability and how this environment is taking sustainability to the next level. So again, thank you for joining us in this first day of our 10th anniversary of Latin American Virtual Forum. Please don't forget to follow our Mexico social media channels through Twitter, LinkedIn, and YouTube. And if you want to hear more from us more frequently, we have 3 main forecasts. The first one is the Mexico BlackRock Encuentro podcast. Also, we have the BlackRock Global podcast, The Bid, and a separate podcast series within The Bid, which is the real leaders of net zero, led by our head of international and corporate strategy for BlackRock, Mark Whitman. So thank you again for today, and definitely looking to hear from you tomorrow in our second day. Gracias.
Sergio, thank you for your time and for your insights. I think it was a great way to sum up our first day's action here at the Latin American Virtual Forum. That brings us to a close for day one. A lot of this content will be available on demand on our social channels, on BlackRock social channels. So I invite the audience to check back in later and see a bit about what we talked about today. That brings us to a close. I'd like to thank all the speakers who've been with us this morning. And it's hasta mañana from Mexico City. Goodbye.